as Treasuries react to some pretty robust economic data all the way around today, which takes us to our talk of the tape. How far stocks are set to go in the new year with several potential challenges still ahead. Let's ask Dan Greenhaus, Solus Alternative Asset Management's chief strategist and economist here at Post 9. Welcome back.
Thank you, sir.
So as we close the week, what are we going to do here with this market as we edge towards the end of the year and go into the new one? Have we done too much too fast? Are we still set up for something pretty good as we begin a new year?
I'm generally a skeptic of any point markets have gone too far too fast. I mean, obviously there's overbought conditions that need to be worked off, but to the extent that the market was, I'll use the word insular, but that's probably not the right word. It's been very narrow.
Until lately.
Yeah, so for the whole year, only 3 sectors have outperformed. But over the last month, over the last fourth quarter, 6 sectors have outperformed. So you've seen the rally broaden out. We all know this. All else equal, I take that as a positive sign and sets us up, I think, fairly well heading into the new year.
Do you think that broadening continues?
Oh, I do. And we've discussed this in the past. And I think if you have 2 avenues here, do I want to continue to invest in the large 7 tech names, let's say, or the broader market? This is not so easy, but I would go with the broader market.
You think we're going to get a rotation from these mega cap names? I mean, there was one note on the street today that suggested it's time to short NVIDIA.
Yes. There's a lot of notes on the street. And a lot of people say a lot of things. I make no comment about NVIDIA, but listen, I don't think you need a rotation per se, because the word rotation implies that money's going to come out of the large cap tech stocks, implying that they're going to go lower in order. I don't think that needs to be the case. Both can go up. It's just a question of relative performance.
Well, some have gone up a lot more than others, like mega cap tech relative to the other parts of the market.
Well, if you're looking at the market as a whole, but if we break it down into individual sectors, for instance, if you look at some of the restaurants, Chipotle obviously is a name that's done phenomenally well, but if you go a little smaller, Wingstop and Texas Roadhouse all outperform. The hotels. We've talked in the past about what Solus does with our money. The consumer-focused space continues to be one because of the strength of the consumer with gas prices down, et cetera. A lot of names exposed to the consumer have done quite well.
So you're not thrown off by Nike in any way? You don't have to speak about Nike directly, but does that make you pause and say, okay,
no,
maybe there's a slowdown coming from the
I'll
the
agree
consumer.
with a lot of what Stephanie Link had to say on the halftime report. I don't think the report is quite as bad as the performance. I say that as someone not involved in the name and not a Nike analyst. But I don't think they said anything particularly worrisome about either. A lot of their issues were concentrated in China, which is less of an issue for what we're talking. Mm-hmm. But no, I'm not thrown off by it, is the short answer.
What about bigger picture? Can the Fed, based on what the data has done lately, declare victory?
No. I was just with an ex-client, now friend, and we were debating this. The idea that the Fed has won and engineered a soft landing, forget my opinion, is completely not accurate. In order to have a soft landing, you will have had to have landed. And right now, interest rates are still at the top. So in my opinion...
Are they? What do you mean that they're at the top? They're not at the top. Interest rates?
The Fed funds rate, the federal funds rate, as controlled by the Fed. In order for them to actually have landed the plane, they will have had to have reduced interest rates by making it up 200 basis points, and no subsequent recession have occurred. Right now, they've done a great job, better than I would have expected 2 years ago, but I don't think you can declare a victory just yet until you've reduced rates, the market remains where it is, and the economy continues to chug along.
Is it your base case, though, that they're going to do what you just said?
Right now, I think there's nothing in the next 6 months or so that particularly worries me. The job market remains quite strong and healthy, and I think the market is, again, if the market was particularly concerned about the economy, you wouldn't see United Rentals, Train Technologies, a whole host of the industrial companies, we've discussed this in the past, doing as well as they have. I mean, the market's not broadening out into a recession for no reason.
You worried that they may wait too long to start cutting, like
they
waited too long
to
start hiking?
I think we should worry about everything they do. They're dancing on the head of the pin here, so to speak, and I don't ascribe any godlike powers to them that are unwarranted. I think these are just a bunch of people sitting around a table trying to control the price of money in a $20+ trillion economy, which is not an easy thing to do.
Don't you think they've done a good job to this point after admittedly getting to a slow start?
Well, sure, they've done a good job after they did a bad job. Although, admittedly, it wasn't all their bad job. But as market participants, we've got to bet on what we'll call expected value for now. What's the likely outcome? And for right now, the likely outcome is that the market continues to move higher, at least for the next couple of months. I see no evidence in the short term here that that's going to abate. And one of my favorite topics when I was on the sell side, and I still use here on the buy side, is someone needs to explain to me why tomorrow will not look like today. And I don't understand right now why that won't be the case.